All right, so we had one of the biggest weeks of the year in the stock market. We're having a fairly decent sized correction. Is it a crash? I don't think so. Some people are prepared for a crash. We also had one of the busiest week of the year as far as earnings go. So I want to get into the market first. I'm going to get into the big companies that release earnings, and then I'll get into the other ones as well. So getting right into it here, as far as the market goes, we were down almost 2% on the week on both the S&P and the NASDAQ. On the month, we're down about 5%. The S&P is down about just over 10% from its yearly high. So that is a pretty good size correction. How low will we go? My prediction is no more than about 5%, but I do think we probably still have some downside left to go. My guess is probably around 4,000, maybe high 3,000s on the S&P will be the bottom. And then I think we finish the year on an uptrend. Will we close higher than the summer of this year? I'm going to say probably not, but I think we probably don't get far off. And then I think it's going to depend on the Fed and the whole recession situation. If it's not a deep recession and if the Fed stops raising or especially cutting, I think we probably see we'll be on our way to new all-time highs, more than likely mid to late 2024. If it's a deeper recession than expected, it'll be probably 2025. So that's my predictions and what I think things will do. As far as earnings go, let's get into it here. I'm going to start with, like I said, the biggest companies, and then I'll get into the medium to small ones. So the first one is Microsoft. They beat revenue and earnings easily, right? Easily beat earnings and revenue. They were actually only up slightly on the week. Again, the big tech names have all gotten hit pretty hard, although Microsoft has held in there better than the other ones. And again, Microsoft did pretty good. Some other ones not quite as much. So we will see how that goes. But again, Microsoft honestly still is too expensive in my mind. Again, if you look at their valuation, there's still a price to free cash flow of 41. 5-year average is 33. So they would have to come down at least a decent amount before I would be interested. The next one is Google. Google got hit really hard, because they beat earnings and revenue relatively easily, but their cloud aspect of their business got hit pretty hard, and that hit the company really hard. They were down. What were they down on the week here? They were down pretty significantly. Almost 10%, which is pretty significant. And again, the one thing that I would start off here by saying is I think the market overreacted to these earnings. I don't think the earnings were all that bad. Again, at least just my opinion here, which is why I think that we have near-term downside, but medium to long-term upside, because I think the market's overreacting here. I think that this is just a normal, healthy correction, right? Google is still, they're actually considerably below their 5-year average valuation, but I think that 5-year average is a little bit rich. If it went below a 20 price of free cash flow, that's when I would be all over it, right? Just my opinion. So let's say like 115 or 110, that's when I would start to look at picking it up. The next one here is Meta. Meta beat earnings and revenue fairly easily. Though again, if we look at the actual price on the week here, it was down also a decent amount. So again, this is a trend that we continue to see. I'm not necessarily a fan of Meta, just my opinion. But again, when you have a company that easily beats earnings and revenue, but yet they're still down, I think that's definitely scary short term, because that shouldn't be happening, right? That absolutely should not be happening. But again, long term, fundamentals win out. So that's why I'm still short-term pessimistic or bearish, long-term optimistic or bullish. The next one is Amazon. Amazon beat earnings and sales, but they did miss. Amazon Web Services did miss, although they were actually they came down, but then they closed higher on the week. So that's a little interesting, but that's how that goes. Again, Amazon, I think, is going to be just fine long term. I mean, they're diversified so well that I don't see any way that they don't perform well over the long run. But they're so big that I don't think they're going to drastically outperform the market or anything like that. The next one is Visa, which honestly did extremely well from what I can tell. That's not the right ticker here. That's the Canadian one. Again, they beat earnings and revenue. They announced a nice dividend increase. They announced a fairly sizable share repurchase program. So again, Visa's still honestly one of my favorite companies because they're so profitable. Their overhead is still pretty low. I mean, profitability like almost perfect, management extremely well, growth extremely well, and not only that, they're actually below their historical valuations. So I think you can be picking it up right where it's at right now, right, in my opinion. The next one is MasterCard, right? MasterCard, again, similar story. They beat earnings and revenue. Not quite as good as Visa, in my opinion. Historically, they have outperformed them a little bit, I believe, but they are more expensive, right? Visa's at a 25 price to free cash flow. MasterCard, 33. So you are paying a little bit more for MasterCard. I prefer Visa, but I think they're both good companies. Next one here is ARE, Alexandria REIT. This is a company I sold recently. They beat earnings and missed revenue. They've continued to come down though. I think that this is a company that's going to have to wait until the rate situation gets figured out. If rates keep going up, this company is going to continue to get hurt. So if we get a rate cut, I think this company will start to do very good. But until then, it's probably not going to happen. The next one is PKG. This is Packaging Corporation of America. They beat earnings but missed sales. So they were actually up on the week though, which is kind of odd to see. But again, sometimes that does happen. Again, this is a company that's going to be fairly cyclical, right? Because when you have a really good economy, they're going to do well. A weaker economy, they're not going to do as well. The next one is 3M. This is a company that I'm sure everyone's aware of. Beat earnings and revenue, although they were actually up initially, but they did sell off as the week went on. Again, not a company I own, just too boring for my opinion. They do have a nice dividend, but again, if we look at this dividend here, right, they have a dividend of almost 7%. The only problem is the dividend is basically flat. And number two, they have underperformed the S&P by quite a bit, which is why, again, I'm not a fan. Again, this is a dividend trap in my opinion. Yeah, you have a nice juicy dividend, but again, the overall share returns are not nearly as good as the S&P, which means why would you buy it, right? The next one is CN. They missed earnings and revenue. Again, they've gotten hit pretty hard this year, but again, over the long run, I'm still bullish on this company. They have such a strong moat that I think it's pretty hard to not want to have a position in a company like this. The next one is KO, Coca-Cola. They beat earnings and revenue. This company's actually been hit pretty hard as well. I think they're basically at a yearly low right now. No, not quite. They're low 51.5. They're at about 55. Again, not growing enough for me to want to take a position, although I think that they're a very solid company. The next one is Next Era Energy. They beat earnings and revenue. Again, just they're a utility, which again, I'm not necessarily a fan of virtually all utilities right now because they are essentially bond proxies, which are going to get hurt higher in higher rate environments. The next one is Quest Diagnostics. This company, they beat earnings, but they missed revenue. Again, this is a company that again, they're kind of interesting to watch, just the field that they're in. The stock was up actually fairly nicely on the week. They actually pay a fairly sizable dividend for a company like this, which is surprising here, which they are growing actually fairly nicely. They have actually underperformed the S&P over the 10-year. Let's look at the 5-year chart, even more. So again, I'm not a huge fan. Possibly would pick this company up at one point if the valuation got good enough. The next one is Robert Half International, RHI. This again another company that's going to get hurt in a weaker economy. They beat earnings and revenue, but they are down. Both are down year over year, which is why I think the company's gotten hurt recently. Although, again, I do think it's a solid company that if the valuation got right, I would possibly pick it up. The next one is Tech Resources. Again, they missed earnings. They've gotten hit pretty hard as well, again, on the week and on the year. Although, again, I think it's a solid company long term. I think that commodity companies are going to do well over the next decade or two. The next one is Teladoc Health. They missed earnings and revenue. Again, this is one of the companies that did extremely well during 2020, 2021. Although, again, they've gotten hit very hard on the year. If we look at year to date, actually 1 year they're down quite a bit, basically at their 52-week low. So again, they're not even profitable either. So I wouldn't be touching this company, at least where it's at right now. The next one is Verizon. They beat earnings, but they did miss revenue. Again, this is another dividend trap, in my opinion. Again, 8% dividend. But again, if you compare it to the S&P, let's do that here. Again, they've consistently underperformed, right? I mean, if you go back 10 years, this company has only returned 33% with dividends. The S&P 226%. Let's go back 5 years. Right? They're actually negative with dividends. So again, don't fall for these dividend traps. Just because a company has a high dividend does not mean anything, right? You need the fundamentals of the business to also be in check. The next one is Waste Management. This is a company that I think everybody probably should have a position in. Although, again, it is a boring company, but it's a non-cyclical company, meaning it's going to trade at a premium, right? So current price of free cash flow is 43, 5-year average is 28. So this is a company that you're going to want to keep an eye on the valuations. When you get a good valuation, this is a company that you're probably always going to want to pick up, at least if you don't have a position in. The next one is Align Technology. Again, missed earnings, but revenue was up. This is a company that I would like to get a position in if the valuation gets in check. It's just way too expensive right now. Actually, it's at 23. Sorry, but the PE, again, 46. Again, that's just too high. I would like to pick it up a little bit cheaper. If the PE went below, let's say 30, maybe even 35, but for sure 30, I'd look at picking it up there. If the price to free cash flow went below, let's say 20, that's probably where I would start to pick it up, because I think this is a solid company. But again, just too expensive where it's at right now. The next one is ADP. Again, another company I'd like to get a position in. Actually, no, it's not the right ticker here. Automatic data processing. I don't know why it's not coming up here. Here we go. They beat earnings, but they did miss revenue slightly. Again, this is a very good company in my opinion. Again, if the valuation is good, this is a company that I almost certainly would pick up. But again, if you look at the valuations right now, price of free cash flow 24, 5-year average, it is below on both of them. So honestly, let's check and see here. Where is it at? Year to date, it's actually near its low. So if I'm being quite honest, this is a company I honestly would look at picking up. I might look to start a position, especially if it goes lower. So this is a company that I definitely would have on my watch list and be looking at closely. The next one is Evercore. Again, they missed earnings. They did get hits. Let's see how hard they got hit on that. Not too bad. They're at 129 to start the week. They went down to about 127, just below. So again, what's that, about 2% roughly? Again, not super concerning. This is a company I have a small position, and I think it's a solid company. Again, it is going to be cyclical, but again, 2.4% dividend. Again, it does have nice growth, and it has outperformed the S&P over the long run, which is exactly what I want to see. The next one is KLAC. Again, this is a semiconductor company. They beat earnings and revenue. This is another company that I would like to get a position in. If we look at its valuation here, it is actually below by a little bit. So again, this is another company that I will be watching closely, because again, I do want to get a position in this company at some point. Though again, you got to keep an eye on the valuations. The next one is Old Dominion Freight Line. This is a company I do have a small position in. Earnings and revenue both up, although it is down year over year. Again, this is a company that's been too expensive to pick up for most of this year. Although, again, I think it is still too expensive looking at the valuation. But if it goes down below like 330 or so, I think I would start to pick up. I would pick up more. The next one is Thermo Fisher Scientific. They beat earnings and revenue, although, again, they've been hit pretty hard. And, again, they are a kind of a medical device company. The problem is a lot of the companies that they provide services to, they relied on a lower rate environment, and that's hit them pretty hard. So again, a company that I might get a position in at some point, although I think that we're going to have to see rates go down before that will happen. The next one is Vici Properties. Again, they're basically at a 52-week low, although again, they beat earnings and revenue. And again, this is a company that I would be buying where it's at right now. The dividend is at 6%, right? And again, I think that they're going to be just fine long term. They are going to be a little bit cyclical, but I think they're going to be just fine long term. So if anything, I would be picking this company up where it's at right now. The next one is Chipotle. Again, they beat earnings and sales. Again, another company that I would be looking to pick up if the valuation got right. Again, it is significantly below its historical pricing, but again, it is still too expensive. But again, another company that I have on a watch list that you want to have on a watch list for sure. The next one is DLR Digital Realty Trust. Again, they beat revenue and earnings. Again, a company that a lot of people like because it has a dividend. It's in a sexy industry, but not good enough in my opinion. The next one is GLPI. Again, similar area to Vici Properties. I do prefer Vici. Again, GLPI, they did beat earnings and revenue. Again, this is a solid company as well, but again, I prefer Vici if I'm picking one. The next one is Steg Industrial. Again, they beat earnings and revenue. Again, solid company. I think there's better options. Again, 4.5% dividend that they are growing ever so slightly. They have not kept up with the S&P. They were for the longest time, but they haven't recently. Over the long run, I think they'll be okay. Will they outperform the market? If I'm guessing, probably not, but I think they'll be okay long term. The next one, ExxonMobil, revenue and earnings down year over year at least. Again, I think oil is going to be okay. I think again, commodities are going to do well over the next decade or so. So I wouldn't be concerned about ExxonMobil. And the last one here is AbbVie. Again, a popular one for the dividend crowd. They beat earnings and revenue, although again they are down over the year. Again, the drug companies, I would be a little bit skeptical of these companies because again, you have governments that are going to be they're going to start coming after these companies. To what degree, I don't know. And not to mention too, for these companies, you need to be really on top the patent cliffs with these companies because if they have major drugs that are coming off patent, that's going to really hurt their bottom line. So honestly, in my opinion, unless you're someone who's willing to do a lot of research, not just a little bit of research, but a lot of research, these companies are not worth it, in my opinion, right? So anyway, that is this week's earnings. Next week is going to be a fairly good-sized week as well, but this is definitely going to be the biggest week of this cycle. So again, like I say, to sum it up, the market is taking this harder than I think it should be. I think, again, not that we shouldn't have corrections. Corrections are healthy because it gets rid of the weak hands, and again, it just gives the diamond hands people and the people who actually are willing to make good investments better opportunities. So don't be concerned with corrections because they will pass, and view them as opportunities to pick up good companies, right? View them as opportunities to pick up good companies. And again, if you have a company that's a bad company, get rid of it. Pick up a good company. So anyway, that's what I wanted to bring up today. If you liked the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.